Welcome, everyone, to the Keys to Home Buying podcast, where homebuyers of all kinds come to learn the ins and outs of buying a home from industry insiders who know it best. I'm your host, Justin Mead, mortgage loan officer, and today is episode 2, where we'll be discussing mortgage loan products. Now, this is definitely not a sexy episode. It's pretty back end, almost boring, but as a home buyer, it is pretty important to know these things because you'll hear these terms and acronyms thrown around a lot. Maybe your friends used a certain type of financing called FHA, but your other ones used conventional, and you're thinking to yourself, what the heck does either of those mean? And you just want to understand, like, okay, why is one better than another? What's the difference? How many different loan products are there? So that's what we'll kind of dive into today. So, excuse me, there's kind of 4 main ones that we're going to be discussing. There are more than that, but those 4 are conventional, FHA, USDA/RD, and VA. The other ones that are fairly common, the biggest one is jumbo. And then a subset of some of the other ones I mentioned is renovation loans. We're not going to get into those today. Those could probably use their own episode. But we won't discuss jumbo since that's a bit of a different animal. But we can talk about kind of what it is when we get into the conventional portion. And then outside of those, there are a ton of niche products that are very specific to certain borrowers in certain scenarios. So, for example, if you're self-employed and you only have 1 year of income history, we could potentially use 12 months worth of bank statement deposits to qualify you through this one program through a certain lender, right? So it's not one of the conventional government-sponsored entity-backed loans like these other ones are, or government-backed. It's just kind of its own thing. So we're not going to get into the details on those. We're going to stick to the 4 basics because those are honestly the most commonly used ones. And we'll start right in with conventional. So conventional financing, best way to describe it is it's the quote-unquote ideal financing of the options because it's very straightforward. Appraisers are very lenient on the property itself, and everybody knows what they are and they know what to expect. So from a buying process standpoint, if you're a buyer and you're submitting an offer with conventional financing, that's going to look very strong over pretty much any other type of financing, right? The only thing that's stronger than that would probably be cash, right? So with conventional financing, there are guidelines that are set to determine who is an eligible borrower. And those guidelines are set by these 2 government-sponsored entities. I referred to that earlier. They're called Fannie Mae and Freddie Mac. You may have heard of them. They're private companies, so they're government-sponsored, but they're not government entities. And what they do is they buy and sell mortgage-backed securities, and they'll package them and just buy them on the bond market. And you can see behind me, actually, we monitor the bond market at all times. That tells us what mortgage rates are going to do. So they're a big factor in the pricing because they're the ones packaging and selling these things. So because they're the ones packaging and buying them, they're the ones that are going to set the guidelines on who is eligible to be a borrower for that type of financing. Now, that's a little more than you necessarily need to know, but it's still good information. Again, you might hear Fannie Mae, Freddie Mac, more commonly referred to as Fannie and Freddie. So with conventional financing and with each of these loan programs I'm going to go through, we're going to kind of hit some key points. 1 being minimum down payment, 2 being occupancy type. We'll touch on credit and a little bit debt to income. Everything else is kind of minute details that once you talk to a lender or talk to me, ideally, that we'll discuss as things come up. So with conventional, this can be used. We'll start with occupancy type. You can use this to buy any type of occupancy, whether you're going to live in it, whether you're going to use it as a vacation home, or whether you're going to rent it out to other people to live there, short-term, long-term, whatever, right? So there will be primary residence, second home is what the vacation home is referred to, and investment property. All right. So when it comes to primary residences, you can buy 1 to 4 units. When it comes to investment properties, you can buy 1 to 4 units. When it comes to second homes, it has to be a 1 unit. Okay, so with a vacation home, the idea is that, or a second home, the idea is that it is a vacation home and you're just going to go there every now and then. You're not buying it to make money. So why would you need more than 1 unit? Okay, so we'll start with primary. You're going to live here. This is where you're going to move. 1 to 4 units. For minimum down payment, you're looking at, if it's a 1 unit, so that could be a single family home or a condo. If you're a first-time home buyer, or if the qualifying income on the loan, okay, so that's everyone on the mortgage who's applying, take their total qualifying income. If it's less than 80% of the area median income, okay, 80% or first-time home buyer, then they'd be eligible to put 3% down. Otherwise, the minimum down payment is going to be 5%. All right, so that's for a 1 unit. Now, minimum means that you can do a lot more than that too, but there's a huge misconception out there that you need 20% down to buy a home. That's just not the case. Back in the day when interest rates were in the teens, that was more recommended because the cost to borrow was crazy expensive. These days, it's kind of personal preference, right? You don't necessarily have to put it down. So if you'd rather keep that money in your pocket, great. If you'd rather put it down and lower your monthly, that's great too. All right, so primary residence, 1 unit, 3% down minimum if you're a first-time home buyer or your qualifying income is less than 80% of the area median. Otherwise, it's 5% down. If you're going to buy a 2 unit, that's going to be a 15% down minimum. And if you're going to buy a 3 to 4 unit, then your down payment is going to be either 20 or 25%. The reason I say or is because it's a difference between Fannie Mae and Freddie Mac guidelines. If you're going Freddie Mac, you can do 20%, assuming you qualify. If you're going Fannie, you can do 25%. You'll have to do 25%. You won't know off the top of your head, and likely your lender won't know just by talking to you whether you'll qualify for Fannie or Freddie guidelines, because they're pretty much the same. There's just some small nuances between the two that make them a little bit different. So often when it doesn't work with one, we'll try the other and it does work. Okay, so that's conventional. When it comes to credit, there's no set, like you have to have this minimum, other than I'd say over a 600 is typically required. To be honest, I don't even know what our minimum is today. It does change. But I would say as a general recommendation, you want at least a 640 for it to make sense at the very least, okay? And just because you have over a 640 doesn't necessarily mean you'll qualify. There are other factors we have to look at as well. So the reason I say that over a 640 is going to be the best that makes sense is because with conventional financing, the interest rate is directly impacted by your credit score. All right, now these other loan products we're going to talk about, that's true as well, just not nearly as harshly. So conventional works in brackets of 20 points. All right. For us, anything that's a 740 or higher is the same bracket. So if you're a 740, you'll have the same credit score hit to your interest rate as somebody with an 810 credit score. But if you have a 725, you're in the 720 to 739 credit bracket. That is probably going to be a little bit less a little bit higher of an interest rate than the other people. So then every 20 points, the bracket moves and almost moves exponentially when it comes to how it impacts the interest rate. So once you get below 700, the rate starts to suffer pretty significantly. Now, the other thing to keep in mind with conventional is this thing called PMI. It's private mortgage insurance. It's one of those necessary evils. You may have heard of it from your friends who own homes, but it's insurance that's required anytime you're not putting 20% down on a property, whether it's an investment, second home, or primary residence. All right. So this insurance is required to be paid by the borrower, required by the lender to insure the lender in case you default on the loan. So if you stop paying, we have insurance in place to reimburse us. You go to collections and that's that. You foreclose on the property, whatever happens, happens. With that PMI, there's 2 different ways to pay it. You can do one upfront fee, just a lump sum at closing, or you can pay it monthly. Most people do the latter. They'll just pay it monthly. It's a little bit simpler that way, even though paying it up front is most of the time cheaper than when you add them up all over time. The main reason most people will just go monthly is because if you're putting 5% down on average, it's going to take you about 11 years until you reach the point where the PMI goes away. Now, it goes away when you own 20% of the property. And there's a bit of a caveat there. So that's kind of the known knowledge is once you own 20%, it goes away. The real truth is that once you get to 20%, you can request it be removed. And assuming you've been making all your payments on time, that should be removed. But if they can choose not to remove it and force you to continue until you own 22% of the property, then it absolutely has to be removed by law. So that's something good to know as well. Most people don't get to that point because, again, it takes 11 years. And typically in 11 years, you're either going to move, sell the home, move, which includes selling the home most of the time, or you're going to refinance it, right? So in the last couple of years, today is January 9th, 2023. Last couple of years, the rates were really good, but then they got kind of bad this past year in 2022. They got pretty high comparatively. Now they're coming back down. They're on a downward trajectory. So a lot of those people that closed last year are going to be in a position where refinancing might make sense. For them, they're also going to experience some appreciation, and maybe they paid down their mortgage a little more with some extra payments. So in that case, when we look at a refinance, if they had originally put 15% down and they were making extra payments and they're in a high appreciation market, well, hey, maybe they're at 20% now, and in the refinance, we're going to get rid of their PMI. Whereas naturally, with a 15% down loan, it might go away in like 5 years. I'm just throwing numbers out there just to kind of give you an idea. So typically, that's why people would pay monthly. What you really want to look at is the break even and the forecast of what the rates are going to be. Break even meaning how much is it going to cost up front and how much does it save me? How much do I recuperate that upfront cost with the savings? How long does it take? And that's something your lender should help you with. So PMI, same with the rates, is going to be severely impacted by your credit score, just to bring it back to what we were talking about at the beginning of this conversation. So low credit, sub 700, your rate is going to suffer and your PMI is going to suffer. So it doesn't always make sense to go conventional if you qualify for one of the other government products that we're going to talk about next. When it comes to debt to income, again, there's no like true line in the sand. Every scenario is different. But in general, we want to see a debt to income ratio of below 50%. I'll probably put together a whole episode on debt to income, so we won't get into that now, but just keep that in mind. Typically, we want to see below 50% debt to income ratio for that back ratio. Keep that one in mind, the back, because there's a front and a back. So on the debt to income ratio, we'll talk about that a little bit more. Debt to income episode. Now we're going to go into FHA financing. I would say between all the 4 products that I mentioned, conventional and FHA are the most common, with conventional coming out on top as the most common. So FHA is backed by HUD, Department of Housing and Urban Development. And this type of financing is really good for people who don't have good credit. Maybe they don't have good income. Sometimes maybe they don't have the money to put down, right? So maybe they're a repeat home buyer. So they have to put 5% down to go conventional, but they don't have it. So with FHA, the minimum down payment is 3.5%. With FHA, you can only buy a primary residence, but you can buy up to 4 units, and it's 3.5% all the way up to 4 units if you're the only one on the loan. You can have co-borrowers as long as they're going to live in the property with you. Then it's still 3.5% as a down payment. If you're going to have a co-signer who's non-occupying, like a parent who wants to help you and just put their name on the loan, well, that down payment is going to fluctuate based on the amount of units. Could be upwards of the 25%, like with conventional on a 4 unit. So keep that in mind. But if it's just you going into the home or you and someone else who's also going to live there, 3.5% up to 4 units. There are some caveats with the 3 and 4 unit purchases. Again, we won't get into that today. That's a bit of a specific scenario. If you're interested in learning about that, just hit me up. I'd be happy to chat. But with FHA, 3.5% down is the minimum. They're lenient on credit. So typically, I think right now we can go down to a 580. Historically, we used to be able to go down to a 550. I honestly can't remember if we're back in that market where we can go down to a 550. But honestly, if you have a 550 credit, you probably want to work on your credit before buying a house, to be perfectly frank. Like we could probably pull it off, but it probably won't be that beneficial in the long run, when you could just take maybe 6 months to build up your credit, get it back to a good spot where you're over like a 620, and now your terms are a lot better with that type of financing. So I say 620 because from what I've seen, that's usually where the terms for FHA start to get a little more reasonable. Terms meaning cost of the rate, if there is a cost, and just the rate in general. And sometimes your debt to income ceiling that FHA will allow will lower based on whatever your credit is. The lower it goes, the less they'll be able to lend to you. So just to touch on debt to income real quick, assuming like decent credit, 640 or higher, they'll likely want to see 55% or lower and on your debt to income. Again, you can't hold me to these numbers because that does fluctuate from borrower to borrower, but most of the time we can get away with 55% as that back ratio cap. So credit score, technically 580 these days, maybe 550. Talk to me if you're in that scenario and we'll take a look. If it makes sense, great. If it doesn't, let's work on rebuilding your credit. But I would say 620 or higher is kind of what you want to target. So when it comes to PMI with FHA, there's two things to consider. There's an upfront mortgage insurance premium and there's a monthly MI premium. So the upfront mortgage insurance premium is owed on every FHA financed loan. It's 1.75% of the base loan amount. All right. So if you're purchasing a home for $100,000, you're going to maximum borrow 96,500. So that's after the 3.5% you put down. Then we take 1.75% of that 96,500 and we add it on top to your loan. So technically your loan to value, take your loan amount divided by the purchase price, is going to be a little higher than what it comes out to if you just take away 3.5%. And that's why, is because there's this upfront mortgage insurance premium. You do technically have the option to pay that at closing. I've never seen it done, but that technically is an option that you have. So keep that in mind. There's always a little bit upfront premium on FHA. And then the monthly is a flat 0.85%. If you're putting less than 5% down, if you're putting 5% or more down, it's 0.8%. So not a huge savings by putting 5%. Most of the time, people are just doing the flat 3.5% and calling it a day. The huge benefit here is that rates aren't as impacted as harshly with FHA in terms of credit. Same with the PMI. It's that flat 0.85, whether your score is 500 or 820. It's going to be that 0.85 no matter what. So when you're comparing conventional and FHA, this is why I say when you're sub 700, it's worth comparing. Okay. Because a lot of the time, the FHA financing will actually turn out to be better from a monthly payment perspective. So again, better is a relative term. It all depends on what's important to you. Is it that cash to close? Is it the monthly payment? Is it just the rate in general? Is that really all you care about? It's totally up to you. So that's FHA in a nutshell. The next one we're going to talk about is USDA/RD. So you'll hear it referred to with either of these acronyms, U.S. Department of Agriculture or Rural Development. Okay, so RD loans, that's a no money down program. So it's pretty desirable. However, it's kind of tough to qualify for. In my experience, you need at least a 640 minimum credit score. It could be possible to go lower. I honestly don't know, but everything I've seen, you need at least a 640. They're the most strict when it comes to debt to income ratios. So I've never seen anyone approved with higher than a 43% back ratio. So it's pretty tight. You can't borrow nearly as much with that type of financing as you can with, say, FHA or even conventional or any of the programs. There's other limitations that are very specific to RD. One of them is geographic location. So if you're buying in Vermont, the ineligible areas are Burlington, South Burlington, Winooski, most of Essex, and a small portion of southern Colchester. Everywhere else in the state is eligible. We're a pretty rural state, so this type of program is pretty decent geographically. So that's step one. If you're looking to buy in central Chittenden County, RD is probably not for you. The next thing that makes it pretty limiting and very specific requirements for RD is the property itself. Now, last I checked the guidelines, this was earlier in 2022, you couldn't have land that was subdividable or subdivisible. I honestly don't know how you say that term, but if the land could be subdivided, that's not allowed. So typically 10 or more acres is where you hit that benchmark. So probably 9 times out of 10, if it's more than 10 acres, it wouldn't work. There also can't be any agricultural equipment on the property, and there can't be any income producing elements. So this is a 1 unit only type of financing. It's also primary residence only. If there's a barn on the property, it's going to be questioned. You got to prove that it's for storage purposes only, especially if it was an active farm before you buying it and the previous owners used that barn to store their livestock. We're going to have to come up with some very compelling evidence that you're not going to do that too. there's a windmill on the property, that's a problem. So there's all sorts of little nuances with USDA/RD financing that make it tricky to qualify for. But if you meet the requirements, you're in. Now, the last one, there's even one more, if you can believe it, is there's an income limit. Now, up to 4 people, that limit, it depends on county, but I think the Burlington area/Franklin County area is about 104,000. And they look at household income. So if you are married and you're the wife, let's say, but your husband is not going to be on the loan, you're the only one on it, you make 50,000 and he makes 50,000. Well, we're going to look at both of those for the income limit. Okay, in that case, most in the Burlington County, I think you'd be okay, but in some other counties like Addison, you might be over the limit. And that's odd and hard to wrap your head around, because for you, the wife, if you make 50, we're going to use only the 50 to qualify you for the mortgage, but we're going to use both of your incomes to qualify you for the income limit for RD. So it's definitely a bit of a weird product. If you have more than 4 people in your home, then the limit gets increased. So it's assuming people with 3 or more kids. If it's a married couple with 3 kids, then they need more income, and okay, let's help them out. That income limit is increased a little bit. So that's RD, tough to qualify for, but if you do, it's a great product. The last one we're going to touch on is VA. Now, this one is specific to veterans. Okay. Now, if you are a veteran, you will have to have been discharged at some point, honorably discharged. So you'll have a DD 214 and you'll have a certificate of eligibility. A lot of the veterans I've spoken to only have the DD 214, the certificate of eligibility, or COE as we refer to it. They don't usually carry them around with you. And even if you had it, you may not know what it was. No big deal. If you get us a copy of the DD 214, we can order your COE for you. That's super easy. So on that COE, it tells us whether or not you're eligible. You want to see entitlement of 36,000 at the bottom, right? So there's some data at the top with your name, your branch of military, your exemption status. So if you were disabled to a certain degree, then you'll be exempt. And we'll talk about that in a second. So below that top section, there's a table that shows if you've used VA financing in the past, where it was used. And then there's a little paragraph below that. In that paragraph, you want to see entitlement 36,000, then we're good. If it says entitlement is 0 and you see that you've used it in the past, and if that property has been sold, then we just need to restore your entitlement and you're all set. So with VA financing, you can use it as many times as you want, as long as you don't have multiple homes financed with VA at the same time. Okay, same thing goes with FHA. And we'll go back to FHA for a second. A lot of people think that FHA is for first-time homebuyers only, and you can only use it once. It's not true. You can buy a house today with FHA and then sell it and go buy another house with FHA. Sell that, go buy another one with FHA. Refinance that to conventional, go buy another house with FHA. And there's time constraints between when you can do this, but generally speaking, you can finance multiple homes with FHA over time. You just can't have more than one at the same time. So back to VA. You need that certificate of eligibility that'll tell us whether you're eligible. This is another no money down program. This type of financing is honestly the best for first-time homebuyers that don't have 20% to put down. Hands down, all around the best, and veterans deserve it. So no money down, no PMI, even if you're putting 0% down. The rates are pretty darn good comparatively. They're kind of like FHA. So even if you have low credit, you could still get a decent rate compared to conventional with low credit. When it comes to credit score, I've seen those go pretty low. Back in the day, we used to go down to 500, I believe. Nowadays, I think it's pretty similar to FHA. 580 or higher is doable. Ideally, you're at like a 620 or higher. Again, we're going to call that case by case. If you're a veteran, you want to get qualified, just call me and we'll take a look and we'll figure out what's going to make sense for you, or if you're even eligible. But credit, pretty lenient when it comes to VA. Debt to income is where it gets really interesting, because the VA doesn't look at a traditional debt to income ratio. Instead, they look at residual income. So they're going to take your monthly income and then take out your monthly expenses, and they look at the dollar amount left over versus the percentage of your debt to income. It's pretty crazy. So I've seen debt to income ratios over 67% still get approved because that residual income meets the guideline. Now, The guideline is based on number of people in the home and region. So we're Northeast. I honestly don't remember the dollar amounts off the top of my head. I'd have to look it up. It's nothing you really need to worry about either, but get pre-qualified with me and I'll tell you where you stand. But VA is fantastic for that reason. Now, that can buy 1 to 4 unit primary residences only, in case of no investment or second home purchases. And really, let's just talk about that. Investment and second home purchases are conventional only programs. Everything else is going to be for your primary residence. Now, the last thing with VA is specific to refinancing. If you are refinancing a VA loan into another VA loan, they have this incredible refinance product called an IRRRL, an interest rate reduction refinance loan. And it's only allowed to be offered if you are refinancing a VA financed loan that already was a VA loan into another VA loan. The rate has to be dropped, I believe, by at least 0.5 percentage point. And the savings you receive from the refinance have to recuperate the costs within a 3-year window. There's no appraisal needed. There's no income documentation needed. It's just slick. You send it through. So if anyone is out there with a home loan that is VA financed and you're looking into a refinance, but you're on the fence, well, just look into it. This product is absolutely incredible. So that's all I'll talk about for VA. And that's kind of everything altogether. So a quick high level of each of them: conventional, FHA, USDA/RD, and VA. Those are the most common products that we offer, with conventional and FHA being the most common. Jumbo, I know I said I would mention what that is at the beginning. Jumbo is when the conforming loan limit is exceeded. So conforming loan limit just increased this year to a little over 700,000. I forget the exact number, but if you're going to borrow more than 700,000, then likely you're going to be in jumbo territory. Now, we'll touch on that real quick, actually, because there are loan limits with FHA financing. I don't believe there are with USDA, but again, because they have income limits and low debt to income thresholds, they don't really need a loan limit because they're limiting you already with how much you can borrow based on that. VA doesn't have any loan limits either. They just kind of follow conventional. Even if you go into jumbo, you can still borrow with VA. So jumbo is specific to conventional. It's kind of the alternative to conventional if you're borrowing at that higher amount. So that's all of them in a nutshell. Hopefully that was informative. If anyone has questions, reach out. jmead@homebridge.com. Set up an appointment today to get pre-approved or just to chat and ask some questions. If you have an idea for a topic for another episode, please reach out. Be sure to hit the bell and subscribe. I hope you have a great day. Bye-bye.